See, MicroFinance South Africa is sounding the alarm over the rapid, largely under-regulated growth of buy now, pay later, that's BNPL services, warning that there are deepening debt risks for millions of South Africans. Marketed as a modern interest-free payment option, BNPL is increasingly being used for essentials like food, utilities and healthcare without affordability checks, credit bureau reporting or clear disclosures. Experts warn this shadow credit system exposes low-income workers, young consumers and the already over-indebted to hidden costs and exploitation. Is this an indication of an ineffective consumer credit system or a lack of regulatory oversight? We have Clive Ramathibela-Smith, Senior Executive Partner, Hecare Capital Partners, joining us now. Thank you for your time.
Thank you very much for having me.
Yeah, it's a pleasure. So buy now and pay later is presented as a modern interest-free payment solution, but is that really what it is?
To be quite honest with you, it is supposed to provide some critical financial assistance. It's supposed to make sure that there's a little bit of affordability. So the idea behind it is supposed to be very well meant, and it's supposed to be utilized to assist people who might have more month than salary, so that they can be able to get to the end of the month by taking in microloans or microfinancing institutions. The unfortunate thing is that because when it's this way, in the pace that it's happening in South Africa, and the lack of regulatory framework behind it, it has unfortunately been misused by those who are providing the credit line.
Right, and I mean, that is one concern. Tell us more, right, because we know it's on the increase. What are your concerns? And also the exposure. Talk to us about how it exposes South Africans to unsustainable debt, hidden costs, and even financial exploitations.
South Africa has a very strong financial sector, and obviously one of the strongest both on the African continent and globally. If you look at the services sector in finance, in particular when you look at the regulatory frameworks, the Financial Conduct Authority, together with the Reserve Bank, they've done very well to keep things under wrap. Unfortunately, what has happened is that a lot of people, particularly working class South African, lower to middle class South Africans, are finding things very, very hard to get by. So what they're doing is that there's a loophole that these financiers have found, a gap, if you can prove that you are earning income, that they can utilize to their advantage to make sure that obviously things such as your buy now, pay later models have taken a spike. So even in debt, obviously, if it's not controlled, just like any other credit that you might get, if it's not controlled properly, if it's not regulated, and if it's not provided the kind of structure that it needs for it to work, what that does is that it puts more burden on the consumer. It also can be mismanaged or manipulated to increase interest rates on those particular loans, because the financier is thinking they're taking a bigger risk, particularly with consumers who don't necessarily qualify for finance or credit. So what they do then is that they give them these opportunities, whether or not you're blacklisted. I must just classify that blacklisted. When South African regulatory framework says you are blacklisted, is somebody that is not qualified to receive any kind of credit from the bank. Mm-hmm. So therefore, these people have nowhere to go. What do? Then they opt for these other options that provide them immediate relief, but long-term pain in terms of returning back that money and paying timely.
Right. So, I mean, we've examined or explored the side of the consumers or the customers or the borrowers, let's put it that way. But one would also expect that even the lenders would, make recourse to borrowers' credit score before advancing any form of credit to them. So why isn't that the case here?
You'll be surprised because of saturation of availability in credit. What some banks, small banks, credit providers are doing is finding a loophole with regards to that. So, for example, even if somebody does not qualify, but they can prove that they've got a pay slip or remuneration slip, they can prove that they've got a bank account and they're receiving money in those bank accounts, and then therefore they can be able to have a little bit of a track record that enables the creditor or the financier to take the risk with that particular consumer. What the problem is here, which is what we are discussing this morning, is that it becomes an even further burden. Some rates can, or some financiers can even charge up to 25-30%. On the loan, which is ridiculous, and because there is no way of tracking or regulating this kind of financing, they get away with it, and sometimes people can pay for a very long time into their life, something that they will never be able to recover from. So yes, you're right. There should be mechanisms. They are there, but there are people now that have taken advantage of the gap between the regulation and what is allowed and not allowed. And they're finding these people who are already indebted and they're not qualified, so that they can qualify them and they can get them money. And so because there's no structural reform in that particular space, it's become very easy to manipulate.
Indeed. So it's a need for structural reform. But talk to us some more about the implication of buy now, pay later not being subject to the core protections of the National Credit Act, and what needs to be done there.
One of the things that needs to be done, obviously, we always talk about it, is we need to have consumer literacy programs about finance, so that the consumer must be educated, consumer must be empowered, consumer must know they have rights, consumer must know the kind of debt they're signing up for, and those things are outlined in the National Credit Regulation Act. However, when the scrupulous financiers are not using those particular trajectories, they're not using those reforms to provide credit, it becomes very hard to take up these people and take them up to task, because they're not embodied into the structures. So one of the things that we've seen happen is, you need to be a registered NCR provider, you need to be a registered financial services provider, but some of these people don't have those, and that's why they can get away with it sometimes. So the consumer has to take responsibility and make sure when they take these credit cards or these advances or these accounts, that they are aware that they might be manipulated to paying overly for a very long period of time. We know this as well, my sister, because it's something that has happened in the United States, in the West. We know in Europe it has happened, where people were duped into taking credit that they cannot afford, and then they struggle afterwards to pay it off. And it can lead to people being blacklisted at some point, because these people, therefore, if you're not paying them, they can take action against you at a legal front without the frameworks that protect you as a consumer. So we need to educate our people. They need to find financial literacy, and also they must be making sure that whatever product they buy or purchase, they understand the terms and conditions.
Right. And finally, beyond the challenges and the issues that we've raised, do you see any merits, any positives in this payment model, and how perhaps can it be reformed?
The reforms are there, but they're at a high level. So we need to make sure that they are done even at a lower level, where people are actually found, where people are, so that it's much more palatable, people can understand it, it's clear, it's concise, and it's able to be practiced at that level. The second thing that is very, very critical in this is that, yes, there is positivity, because some people can say that it's not justifiable, that if the bank says no to you, you can't go elsewhere. But the problem is that when you go elsewhere and it's not safe, and it's a person or a financier that wants to take advantage of you, you can end up in more debt than what you bargained for. So that needs to be clarified. And the third and last thing I would like to mention is that it's the responsibility of the South African Reserve Bank, together with the Financial Conduct Service Authority, which is the FSCA, and also the regulatory frameworks within the banking structure including the NCR and the NCA, to make sure that these regulatory frameworks are practiced and are accurately complied with. In that way, the consumer can be protected, but also we can be able to get some relief when we need it as a consumer, but not taking advantage of the fact that we can be charged up to upwards of 30% to return of interest on the products that we buy or purchase in account or credit.
All right. Clive Ramathibela-Smith, Senior Executive Partner, Hecare Capital and Partners. Thank you for your time.
It's absolutely a pleasure.